All right. Back again for another episode of Live Q&A with Matt, the Mortgage Guy. I'm here to dispel all the mortgage myths, give you whatever answers you want to any real estate questions you got from somebody who's on the front lines in the fight every day, all day, with clients, realtor partners. I don't know how your current market is, wherever you're at, but I can tell you Northern California, most parts of California where I'm doing a lot of business, it's crazy. Frenzy buyers are back, kind of how we saw during some months of 2021. Will this last forever? I doubt it. But currently, in this current environment with very low inventory, it is tough on buyers. And tough is a nice word. I talk to real estate agents day in and day out. So having a great agent matters and it's helpful, but it doesn't make it to where it goes from super difficult to easy, right? It's still hard. For the best realtors with the best clients writing the best offers, it's hard to get something accepted. So love to dig into your questions, whether it's related to the market or it might not be. It might just be related to your specific scenario. Hey, I'm self-employed. How long do I have to show income to get qualified? Hey, I went from hourly job to a job where I'm earning a salary now. What is it going to look like for me getting qualified going forward? Any and all questions, please bring them. If you have them, know that there's a dozen other people that have a similar question or can learn from you, because what I'm trying to do with this live, with this YouTube channel, with anything I really do across all socials, is empower you through education, empower the consumer, so that when you're out there putting in bids on a house, when you're making the largest purchase of your life, which would be for most folks, you feel good about it. You feel confident. You know your numbers. You know going into it what your monthly payment's going to be, what your total cash to close is going to be. There's not surprises. It's not something that feels super scary. It should be some more excitement, right? So anyhow, that's my rant to start off the day. I'll jump into your questions. As we answer some questions, it might spark some ideas in my head, things I'm thinking, things I'm talking about. But just know that these first couple months of the year, in general, are pretty light on inventory. So the fact that we have low inventory shouldn't be a big surprise. How low it is certainly is the issue, and the surprise is, in a low inventory market where there's only a couple months of inventory in a January or a February. If you're out there looking to buy and there's lots of other people looking to buy, it can feel competitive. In a market like this one, where in some places of the country, I'll use Sacramento where I'm at as an example, when you've got 15, 16, 17 days of inventory, it can feel near impossible, right? I understand that it's also an unfair game to some folks. And I've been thinking a lot about that, where, somebody with 30% down with $350,000 in the bank, who can write an offer with no appraisal contingency, can let, the sell side know through their real estate agent, through attaching proof of funds, through having us talk with their loan officer, all these things, which I try to remind clients of mine that are in that position. You're lucky to be in that position. Those folks going out there having a hard time. Imagine what it's like for somebody with 5% down, for somebody with 3% down, who doesn't have all that, to throw at the seller who's looking at 20 offers at a time, 30 offers at a time. It's a wild market. I want to help you navigate it. I want to make sure that, not just the best of the best can get into their first home or get into contract. I want to make sure that, at scale, everybody who wants to become a homeowner can become one. And I think that I've gotten more clear with my vision on what I'm trying to do. All the videos YouTube, Instagram, Facebook, even TikTok now, are meant to help folks get themselves more educated, because that's what's truly missing. If you want to talk about, how somebody goes from not knowing anything and not being ready to buy a house to prepared, ready, in a position to submit an offer and buy a house in a few years' time, I think education is the gap that gets them there. So I'm going to try to do my part, educating as many folks as possible, because I believe in home ownership. I believe in the power of real estate for building wealth, and I believe it should be available to everybody. Not the only one that believes that. So luckily, I've got lots of other folks who are going to be doing the same thing, empowering folks through education. And so, let's get started. Christopher, thanks for joining. I saw this question come through nice and early, where you're talking about closing rental number 2 at the end of March. Congrats on that one. Once it's rented, how long do we have to wait before trying to buy number 3? Only debt are the mortgages and a $75,000 HELOC. Once you've closed on that, there's no amount of time. And the way you ask the question makes me think that you're saying, how long do we have to have it rented before we can buy number 3? In your eyes, you want to be able to add that rental income, or at least offset the mortgage with that rental income, so that you can qualify. So if it's a debt to income question, as soon as you close on it, you've got a lease agreement in place. Most lenders can use 75% of that lease agreement. Let's say the lease agreement's $2,000. We use $1,500 as income, and it's going to offset that mortgage payment. So ideally, if you're getting $2,000 in rent, you've got a $1,500 or $1,600 mortgage payment, and that 75% factor that we have to use is going to offset it, right? Because if you're showing a loss on paper for this property, it's going to hurt your qualifying. But great question to ask whoever you're working with, because they've got all your information already, and they can take a look and say, you just ask them point blank, could I qualify to buy another place in April if I wanted to? They should be able to tell you, well, currently you've got a 49.96 back end DTI ratio. If you rent it for this much and we offset your current, it's going to put you above 50. Or, maybe you've got a 33% ratio. This thing is a great investment that's going to show positive as far as the 75% of lease agreement versus your mortgage payment, and you're all set, qualify, no problem. So they're the best person to talk to, because you've already been working with them and they have all the information to be able to calculate that debt to income. But there's no waiting period that says you've got to wait 6 months after the lease is in place to use that income. There's no wait, like you can't buy rental property number 4 and 5 without 6 months in between, anything like that, right? The only thing that's going to stop you is debt to income ratios and qualifying. So hopefully that helps. All right, Sherry, thanks for joining. Appreciate having you here. Appreciate the question. You've got income as an independent trader with no W-2 jobs last year, but I worked as a W-2 employee previous years. How to show mortgage for income job status for my trading capital gains investments. Unfortunately, if you went from W-2 to now you're just showing income, quote unquote, self-employed or trading income, I've seen in the past where somebody's got this income year after year. You could use it. If you've only got 1 year of it, I can tell you with absolute certainty, no lender is going to be able to use that, unfortunately. So if that current income is trading income and you've only got it on taxes for 1 year, not going to be able to use it. If you've got it for multiple years, then you've got a shot. So I would, that's how I'd answer that one. Joey Garessi, good to see you, brother. Now, whenever I see Oklahoma City Thunder, I think about you, brother, because of some conversation we had about basketball. Speaking of basketball, Sacramento Kings, Made a couple trades before the trade deadline. It's going to be a good year. I'm telling you, we might just make that that play-in, that 10 spot. If friends are looking to get into rentals as partners, what are some of the things you advise them to iron out in the beginning? Oh man, that's a good question. This can get so tricky, dude. I mean, I think although the idea of it sounds great, right? You're like, okay, we're going to pool our money. We're going to put it together. We're going to buy things as partners. I think when you're buying single family homes, it's likely more trouble than it's worth. And I would say, like with anything else, you want to have an agreement in place. You know, your partner knows, everybody knows, hey, listen, we trust each other and a handshake is plenty fine, but let's have this in place just in case. What happens if you want to liquidate and your partner doesn't? You know, have an agreement in place that says upon one partner wanting to liquidate, this other partner has 6 months to refinance or do something to pay that partner their fair share. And what's their fair share? Do you take market value versus what you guys owe? Maybe minus fees, because you would have to pay fees if you sold it, right? You'd have to pay a real estate agent and some title fees. So maybe if it's worth 300 and you guys owe 220, it would be 300 times 94% or 92% to get the like net after fees number minus what we owe, and then divide that by 2, and that's what a partner would be owed. And one partner can't just want out and then expect that money the next day. They can say want out, time starts for 6 months to get it out, right? Because things are going to change. No matter how much you think that things will, like, we're both buy and hold and we both want to keep those things forever. And 5 years from now, one of you is doing all kinds of great things and says, hey, I know how to get great deals on multifamily, or I know how to go buy a storage unit and fix it up. Like, I want this equity I have in these 3 or 4 singles now, right? Like, get me this 300 grand. I'm going to go turn it into 2 million by doing something else. Not having all that stuff down from the start.
Could you say that again?
Could be detrimental.
I'm having trouble hearing you.
My Apple Watch is talking to me. Sorry. So that's what I would say is, if you do it, have a lot of stuff in place that gives clear direction to what happens in an event where one partner wants to liquidate, pull out of the partnership. What happens in the event that, I don't know, there's a lot of different things that can happen where 3, 4, 5 years from now, you're going one direction, partner's going another, and you've got to make some decisions where it'll be less of an argument if there's an agreement already in place. That's my 2 cents. Hope that helps, brother. I mean, ideally, if you're doing single family stuff, you buy one, they buy one, you guys can still help each other out and talk shop. As much as I'm kind of leaning towards avoid the partnership, I can tell you I've seen amazing partnerships. I started working with somebody in 2014, a buddy of mine. And when I say working as a mortgage broker, helping him out as a mortgage broker, buy and refinance properties. Him and his partner ended up buying 24, 26 single families. And they've always done whatever they do investment wise together. They're in the process of doing a cash out of 13 different properties to go on and buy a bigger investment. And I know they're still getting along. I know they're still partners. They've done great. So I guess it can work. I would want to have every I dotted, every T crossed, and talk to maybe somebody who's been in a partnership or has some experience with, like, what are the 10 things that could happen, and how do I write crystal clear instructions on what happens in those cases so that we're both clear. And then it's just like, hey, it's not personal. It's just like, here's what we agreed to up front. Corey Brunson, thanks for joining, man. I appreciate you coming on. I appreciate you asking the question. I've got a ton of questions on these 40-year mortgages, and I can tell you Yeah, there's something that a lot of people are thinking about. I'm thinking about it. Other mortgage broker friends are thinking about it. The one rental at a time community is thinking about it. And when you say roll out the next year or so as a boom to my business, rollout would mean Fannie and Freddie get behind it. Fannie and Freddie create a 40-year mortgage product, which I don't think is going to happen in 2022. For anybody who doesn't know, there's 40-year products out there currently, in the non-QM space. So it's not like government-backed Fannie Mae, Freddie Mac widespread program for 40-year mortgages. But if you go to a non-QM lender, you can get a 40-year term. You can get a 40-year interest only for the first 10 years, then amortize over 30 after that. Fees are a little bit higher, rates are a little bit higher, but it's out there. I don't see it coming in this next year. I wouldn't be surprised if we got it in the next 24 months. The reasons I don't see it coming, Corey, are because I think it would be detrimental in the short term, where we see this price appreciation like runaway train, right? 40, 50% in a lot of markets over the last 24 months. Add fuel to that is more bad than the potential good you could see by telling people, hey, listen, affordability is an issue. We want you to be able to afford a house. Entry-level buyers who might be looking at a house with an $1,800 mortgage payment versus being able to rent for $1,500, flip-flopping that a little bit to say, hey, if you buy it on a 40-year, your payment's going to be $1,450. It's going to be cheaper than rent. We want to get you on the property ladder. I agree with that sentiment, and I think that that's a good idea. I just don't know if the timing is right for it. And I would also like to see it to be only certain people would qualify. Less than 100% AMI, first-time home buyer, whatever criteria you want to put on there. I don't think you give it to everybody because, like most anything that has to do with debt, it could be used in a way that would be detrimental to folks. I'd like to see it used as a way to get entry-level buyers in the game, right? So that's that. Oscar Romo, appreciate you. The super chat, is that what it's called? Yeah, I appreciate the super chat. And this is an amazing question. And I hope I give you your $5 worth with an in-depth answer, because there's going to be a lot of people in your position that tell me, or tell any mortgage broker for that matter, hey, I'm an FHA. I've got plenty of equity. I don't want to pay mortgage insurance anymore. What should I do? For your specific scenario, I don't have the loan amount or the PMI amount, but it's most likely that your 2.875 with mortgage insurance is going to be a lower payment than a 4% with MI. I got him, Corey. Don't you try to step in here, bro. I got this, dude. I'm the professional here. He's saying don't refinance, let the process play out. I don't know about the process playing out because I don't think rates are going down. But with refinance, it's relatively simple in my eyes. It's cost versus benefit. And in your case, Oscar, you might look at a refinance, and depending on the mortgage broker you speak to and how they present it, it might show a little bit of monthly cost savings, but probably not much. 3.875, 4% conventional loan with no mortgage insurance is probably going to be the same or even slightly higher payment than 2.875 with mortgage insurance. So you're just going to leave that mortgage insurance on there, truth be told. And it's just like added interest, right? Because let's call the rate 3.75. Back in August, if you could refinance to a 2.75 and refinance mortgage insurance off of there, great. You remove that mortgage insurance. You look at how much it cost you to do it versus the monthly savings. And you might say, okay, within 18 months, 24 months, I'm going to break even on that. But if it's going to cost you, which all refinances cost you, no, let's not pretend like all refinances are free and we got a bunch of nonprofit mortgage companies floating around out there. It costs. That cost to do the mortgage, if you're not gaining anything besides being able to say, I don't pay mortgage insurance anymore, then it's all for naught, right? Because your 2875 with MI is effectively a 3.75 interest rate if you just lumped interest and mortgage insurance all into one thing and pretended like it was, the same cost. You basically got a 3.75 interest rate. You wouldn't refinance from a 3.75 to a 4 because you'd be going the wrong direction. So this is most certainly leave it alone type situation. Now, if you had a ton of equity, so much so that you could pull 80,000 in cash out and you kept something like a 4% interest rate and you had no mortgage insurance, then it would be like, do I want to go from 3.75, which we're calling your current loan 3.75 with mortgage insurance, to 4%, take this 80,000 out, go redeploy that, investments, debt pay down, whatever that is, that's a different conversation. But strictly refinance to remove mortgage insurance and not take cash out, like it's a no go. All right. Yvette Hudson, thanks for joining. Thanks for the question. This is, these type of questions, I appreciate them because these are the things that everybody is wondering. Sure, you could Google it. Sure, you could try to find the information online, but here I am in the flesh, mortgage broker who's in it all day, every day, and I'm giving you an answer based on February 14th, 2022. You search online, you might find the response from 2016. That's not relevant anymore for a lot of these different scenarios, right? So thanks for joining. Kudos to whoever's on here, educating themselves, getting better and smarter every day in regards to mortgage financing. It's not necessarily hard. The 1099, where this gets difficult and where I think people misunderstand it, is you're self-employed. If your spouse on their self-employed income, and 1099 is usually going to be filed on a Schedule C, if they've got $92,000 in income on that Schedule C, but they've got all these different write-offs that are legal write-offs, but the accountant is great and says, hey, you can take this as a write-off, use this as a deduction, home office, this, that, and the other. And then the bottom line says 17,000. Well, to a lender, 17,000 is what your income is. And so the W-2 income is more straightforward. You make 60,000. Your spouse who's 1099 makes 17, even though 95 is up top, right? That's a gross number. We're looking at net as a lender. So the net number is 17,000. Now you've got a combined income of 77, right? Some people say, no, I make 60 and she makes 95. No, on the 1099 self-employed income, we're taking the net. We're taking the bottom line number. So that's where it's going to get hard, Yvette. It's not that, it's going to be impossible or that you can't get a loan as a self-employed borrower. Reminder that it's more important than ever to speak to a mortgage professional you like and trust, and don't do yourself the disservice of trying to get a quick answer. Go talk to somebody. If you're really, truly looking to buy a house in 2022 and beyond, do a full application, upload all the docs they're asking for, answer any questions, and provide whatever documentation is needed to truly pre-approve you, to tell you, okay, you could buy something up to $450,000 with 5% down. Here's what your options are. Here's what it looks like. Here's your monthly payment. Here's your down payment. A lot of people want push button get mortgage until they realize that's a recipe for having a deal fall out. That's a recipe for paying for an appraisal, paying for inspections, and 3 or 4 weeks into the process calling me and saying, hey, this lender told me I was pre-approved or pre-qualified. I got into contract and now they're saying they can't get my loan done. It was the lender's fault for not being thorough enough up front. And truth be told, as a consumer, it's partly your fault by not wanting to provide that stuff up front. But you wouldn't know any better, right? So maybe I'll be easier on the consumer. Like you didn't know, just this lender didn't ask for the stuff. Let me throw this up because if anybody wants to get in touch with me and my team, we're happy to help. Go to greatmortgagebroker.com. It's quick and it's easy. It's painless. A few questions, where you're at, how we can help. We'll be in touch shortly. We'll give you good advice, whether you're going to work with us or not. The good advice is always free. So that's that. Oh, I skipped this one. When are the higher fees for high balance loans rolling out? Fannie and Freddie, I believe, were April 1st, but I would say it's hit almost every rate sheet already. As a broker who's got 40 lenders I'm signed up with, and I truth be told, I price 5 or 6 of them every single day. The 5 or 6 I price every day all have it baked in, I believe. There's some second home stuff where if we have a lock and close it before March 14th, we can not hit with that price hit, but that stuff should be baked in already, unfortunately. Nate and Jess, good to see you guys here. I appreciate you guys' loyalty and showing up, and you guys ask great questions. You guys also provide some great insight and real life experience for other people on things you guys have done. So thanks for being here. Been trying to buy in this crazy market. Looks like it's currently common for people to do a 15 to 20% appraisal gap. We lost a bid 100K over ask. We did 18% over asking at 80%. Holy guacamole. So I'm guessing quick math in my head says that 20% over ask on, a $500,000 house is 600 grand. So maybe it was like 500K house and you guys bid 590. Wow. That's crazy. Whereabouts are you guys at again? I'm seeing maybe equal amount of craziness in Sacramento. List at 470, getting contracts at 550. Yeah, so I guess that's close to 20% too. 15 to 20% above. No appraisal contingency. I don't think this current madness, it's like I told people before. It's not going to be this crazy a few months from now. But keep in mind, it doesn't mean it's going to be cheaper, right? You might have stuff listed at 470 that sells for 550, 20 offers. It feels wild. And people are like, okay, cool. Oh, wait. If you tell me more inventory is coming, it's going to be less crazy. The problem is in July, that same house might be listed at 575 and you might get it for 575, meaning it's not cheaper. It's just going to be less competitive. Hopefully that made sense, because that's what I feel is coming, and people miss that distinction where it's like, yeah, you're still going to pay 575 versus 550 today. 550 today felt worse because it was listed at 470 and it got bid up to 550. There's that. Holy Colorado. 550 got bid to 650. We did 630 with 50K appraisal gap. That's crazy, but I believe it. That's a lot of parts of California are that wild. I think this question is for me. What region do you work in? I'm located in Northern California. Do a lot of business in Sacramento and surrounding. Truth be told, do a lot of business all over California, and licensed in 44 states. So most states excluding a couple where it's harder to get licensed and it's taken a little time to get up to all 50. But if you reach out to greatmortgagebroker.com, the lead intake form we've got, even the states I'm not licensed in, I've got a great dude, Ben Lavender in New York. I've got the #1 broker in Nevada, Elena Boland. So places I'm not licensed, I'm going to be able to refer you to somebody who's the best in the business. The places we are licensed, I'm going to get you with a team of mine that's going to be able to help there. So really, we doing stuff all over the place. Just did a 360-day lock today. Do you see rates going over 5 this year? Wow. I'd be interested if you don't want to share the terms here, shoot me an email to matt@mtmg.com, Carrie. The terms of that 360-day lock, because from what I've seen, they're expensive. And what I mean by expensive is like if 399 was a rate that I could give you today, and your 360-day lock is like 4.75, that's, expensive in a case, because it's all like on this continuum of, 4.25 is this much and 3% is this much. I'd just be interested to see what that 360-day lock looks like. Mr. L, rate's not going up till July 1st. I'm not sure where this came from, but I would go to mortgagenewsdaily.com if I were you. And you could go back to December, where the average rate was about 3.25 towards the end of the month. And then you can look at today's average rate, which is 4.1. That graph would determine that your comment, what's that show? Like Maury Povich? Determine that was a lie. Rates have gone up. They will continue to go up. I would guess that July 1st, they're going to be more expensive than they are today. It's been a wild ride. Today, the Fed was meeting for like an emergency meeting at 11:30 Eastern. I don't know if anything came out of it. I've been busy talking to realtors and talking to consumers and trying to run a business. But if anybody heard any news from the Fed emergency meeting today, let me know. I wouldn't be surprised if they ticked up the Fed funds rate by 1/4. We know for sure in March they're going 50 basis points minimum. But yeah, that looks like some fake news that rates are not going up till July. Thanks for the love, Nate and Jess. Appreciate you. All right, Christina, this is a great question. I'm going to clear something up for you today, which hopefully if you talk to the broker that she's referring you to, they can also clear it up for you. The broker is not charging you a fee. Brokers do not charge a fee. The bank is lending you money. They're sending the loan to Fannie and Freddie just like a broker is. They've got their own rate sheet, just like all the wholesale lenders that I work with. And so in most places, you get a conventional loan, you probably go to your bank today, which are like, they're not charging a fee. They've got 4.25% for you. They're going to charge underwriting fee, maybe a processing fee, maybe all those fees combined are $2,000 and a 4.25% interest rate. And you're on your way. A broker gets to look at all the different wholesale lenders. And I can look at Home Point Financial. I can look at UWM. I can look at EPM. I can look at Remen. I can look at, the list goes on and on. I got 4753, whatever the number is today, of lenders that I can choose to broker this loan to based on your credit score, based on your down payment, based on your files, your profile. I'm going to send the loan where I can get you the best terms and get you closed, easy process for you, fast timeline for the realtor, for the, seller, everybody else involved who needs this thing to close in 25 days. That's a consideration as well. But I'm going to go somewhere and maybe there's a 1055 underwriting fee. Maybe the broker set up like I am where I just pay the underwriting fee. It's not that I'm not charging it. It's not that you're not getting charged the underwriting fee. The wholesale lender's got the fee and I'm paying for it, right? No underwriting fee, no processing fee, and 3.99%, right? or maybe it's 4.125. I don't know, based on your credit score and all that other scenarios. But there's no like extra fee. There's no like, I'm going to charge you this to send your loan to this place. The way the broker gets paid, the wholesale lender where we send the business to pays us a fee. Nothing on your side. As a consumer, the broker is better, cheaper, faster. Way faster than a bank. Old processes where it takes 40 days to close a home loan, you won't find that on the broker side. You can find that at these banks for sure. So anyhow, hopefully that helped a little bit, and you could do yourself a solid by just going to your bank and saying, listen, I'm looking for a home loan. As of today, what could you guys get me? I'm putting 5% down. I've got a 780 credit score. They can give you, some type of loan estimate, and then talk to the broker where you're pre-approved and ask them to do the same thing. There's not a commission fee of up to $1,400. It's something different. It's either underwriting fee, processing fee, something else. And it's not, but here's the thing. What if there's this commission fee, and I'll just play the what if. There really isn't. It's probably something different. And maybe it's just somebody getting confused and the broker is calling it that for whatever reason. I wouldn't know why. Let's say their 3.99 has 1,400 in broker commission or 1,400 in points charged to you, whatever that is. But the rate is a quarter better, meaning you're going to save $46 a month forever, then it's well worth it. Or the broker could move the rate up a quarter, make this $1,400 disappear, and give you $2,500 in credits. Then they're paying you to get the loan. That's my long-winded answer. Hopefully that helped. Slim, are you licensed in North Carolina? The answer is yes. GreatMortgageBroker.com. Let us know how we can help. We'll get someone chatting with you soon. Obviously, I can't talk to every single person that comes across our desk, but we got great people. And I've got different folks designated in different states. They're going to be able to help you out for sure. Where did we leave off? Yvette. What were we talking about, Yvette? You said in Texas. Your W-2 and your spouse is 1099. All right. Talk to, I know a great broker in Texas that rather than take the deal personally, because Texas has got some wonky stuff, I'm letting Mark and his team handle it. So let me know. Let me know if you need a great referral in Texas. We'll set you up. Best way to do that is just through that same link, greatmortgagebroker.com. They know where to direct you and how to put you in good hands. Forensic pepper. This is a great question. Sorry, I got my ears itching. Are you still able to structure a first mortgage 80% and a second at 20% to avoid PMI? Certainly can do that. I didn't mute myself, did I? By pressing this button back here? I'm not a gamer, so let me know if you can still hear sound. Not used to all this fancy equipment. Okay. I recorded a video on this, and I don't know if it went out yet. It might go out sometime this week, to be honest, about there's a lot of these products out there. You can do an 80-10 is the more common one, because there's not a lot of lenders going to 100% LTV. But to avoid PMI, if that's the only thing you're trying to do with this loan, you can do either a 10% down loan with MI completely removed. You can do 80% first, 10% second, and then 10% down. And in that case, there's no PMI. There's a lot of different ways to do it. There's no real 80/20s nowadays because no lender wants to take that risk. That second 20% is just something that, 100% financing. But unless you're doing a VA loan or a USDA loan or some sort of down payment assistance product, those things just really don't exist. But there's certainly a lot of seconds that exist. And I know, man, I shot that video last week. It's got to be coming out sometime soon, where for the jumbo stuff, we're doing an 80% first, a 10% second, and 10% down because those are gaining in popularity. There's a lot of folks that want to buy jumbo, where we can keep the first conforming, do a home equity line or a second behind it, and then 10% down. So hopefully that helped. All right. Tanisi Adams, thanks for joining. Thanks for the question. Appreciate you. We currently have a 4.75 on a 30-year with 84,000 remaining. House value is 620,000. Is it worth it to get a cash out refinance now or wait? I'll try to give you my straightforward, honest, quick answer because we could make this a 30-minute discussion. The most important piece of this question is what will you do with the cash out? If you say, hey, listen, I got a bunch of equity. It's just sitting there sleeping. It's dead. It's not doing anything. I want to access that equity. I'm going to do a $350,000 loan. After I pay off that $84,000 first, and there's a few fees built in, that's going to put $260,000 in my pocket. I've always wanted to own a Hummer. I've never had a boat. You go blow that money on silly stuff that's going to depreciate in value. Never, ever, 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 ever would I tell you to do that. That would be a bad idea with a capital B. But conversely, gosh, I'm using big words today. I'm thinking that I'm on it today. The coffee is just flowing. My brain is firing on all cylinders. Conversely, I surprise myself sometimes. College educated, but I think of myself as a simple man. That 260,000, if you go out and take that, divide it by 2 and deploy to 2 different investment properties, or divide it by 3 and buy 3 different properties, cash flowing, appreciating over time, tenants paying down your debt, all the good stuff that comes along with real estate, that's a sweet deal, right? And you've got a payment on your primary that you can afford, you're comfortable with, and you're not taking on too much risk. That is good use of that money, right? Or take that 260 out. You've got 42,000 in consumer debt that's been weighing you down. You're going to pay that off. Finally, get those student loans paid off it's been nagging you and it's been hanging around. And you're going to invest $100,000 in a business that's going to spit off a ton of income, allow you to quit your day job you've always dreamed about, and buy a rental property. Do all those things, right? That would be something that would be worthwhile. But you don't want to pull out equity. You don't want to do a cash out refinance just for the sake of it. Just because you have equity doesn't mean you have to access it. Some people are going to look at all that equity and go, it's going to drive them crazy to just have it sitting there doing nothing. Others, pulling cash out and owing more debt is going to make it to where they can't sleep at night. They're going to be stressed out. They'd rather have a plan where they're trying to pay off that remaining 84, right? Listen to all the Dave Ramsey you want. Do that if you really want to. Me personally, sub 4% interest rates, no way you'll ever catch me aggressively paying off mortgage debt that I can write off on my taxes. That's just me personally. Everybody's different. I don't judge anybody who says, hey, listen, will you help me kind of put together the numbers? I'm trying to pay extra towards principal and get this paid off. If I have my house paid off before I'm 50, it's going to provide me a real sense of peace. I'm not going to have to worry about anything if my primary is paid off and all I owe is taxes and insurance. Even if it slows them down from other investments. Other people don't want to be slowed down. Those other investments are important. they'll go out and they'll find home run deals that are going to pay them much more than their mortgage payment every month. So now they're free rolling on their mortgage, right? So everybody's different. Hopefully that helped you out. We want to use most of it to purchase a fourplex investment property. I like that idea. You know, some people would flame me and say I'm an idiot. You know, Dave Ramsey might even call me an idiot, but that's all right. I'm not trying to scrimp and save and pay off debt and hope that I can rub a few nickels together when I'm 64 to be able to, you know, go to Denny's twice a week. Living a different life, Mr. Dave Ramsey. So you can keep all that advice for sure. But I don't know. For some people that works. For some people that's what, you know, makes them feel comfortable and safe and secure and warm and fuzzy. Where can I get market trend data for my particular region? There's a ton of different places, I'm sure. You know, I've got subscription services that you wouldn't even necessarily have to pay for, you know, like my Keeping Current Matters or you know, Black Knight data, all these different ones where I pay to have it delivered to me. You can go find it, I'm sure, for free. But I would be curious to see what Black Knight data has. Black Knight data. I'm sure they have regional stuff. Yeah, get yourself onto little known site, google.com. I'm sure you can find some good stuff. All right, Yanni, this is a good problem to have. You want to know whether to throw $24K extra at your mortgage every year or $2,000 per month. Well, some of those, you know, gurus out there will talk about how much better it is to pay a big chunk at once than $2,000 per month. Sure, you pay $24,000 in March versus $24,000 March, April, May, June, July, or I'm sorry, 2 every month for the next 12 months. You're going to save a little bit in interest. I'm telling you, it's not a huge number. Maybe it's a few $100. And so you ask yourself, is a few $100 in interest saved by paying that $24,000 in March more important to me, or by paying $2,000 a month, you get to save the little, you know, nest egg emergency fund, whatever you want to call it, 24,000, and go 24, 22, 20, 18, 16, 14, 12. And, you know, if it's just truly just there every year and you can just throw that 24 and it doesn't deplete any sort of emergency fund or deplete any other savings account that you need to be there, then sure, go ahead. That's going to be the one that saves you the most interest. But if by throwing 24 out there, you provide yourself with a higher level of stress, or maybe even if something comes up, you'd have to pay out of pocket or pay on a credit card. You know, if the AC breaks in July, then I wouldn't do that, right? Because the AC breaks, you put $7,000 on a credit card and spend, you know, $2,400 in interest over the next year and a half paying that thing off. That's worse than $2,000 a month going towards principal all at once, saving a few $100 in interest. All right. I'm guessing Tanisi liked Conversely, little $5 super chat. I appreciate you. Thank you so much. I know it's just because I use Conversely. I'm going to have to use that every single week. You know, it's a fun game to play. Somebody was talking to me one time, is like having 2 or 3 words I got to use over the 1 hour period. We should start every live with like 5 words that somewhere during the course of the hour, I've got to work those 5 words into the segment. That'd be cool. While I've got great ideas, I'd be curious to know, is anybody here on TikTok. Anybody think that a live Q&A like this one would resonate or be useful on TikTok? I've started to do more content on there because it's fun. And my marketing team seems to think that it's going to, be useful, help people out, because it's fun and educational all at once, what do they call that? There's a word for fun and educational. Valuetainment? No, that's my buddy Patrick Bet David. I digress. I'm curious if anybody thinks it would be useful. I saw a real estate agent doing a live today, and I was like, oh my gosh, maybe live Q&A on TikTok. People on there are kind of brutal. Maybe I'll just give it a try, right? What's there to lose? Okay, so I don't think that there's many dancing. You know what's funny, Herndon? I know it was all dancing to begin with. It's like very little dancing. I mean, I don't know. Maybe I don't see the dancing because I only like the stuff that's like real estate related. But I go on TikTok and all I see is funny real estate stuff. If the market's so crazy it makes you want to cry, you just got to laugh at it. You got to laugh at the craziness. I think it's what the realtors are trying to do to cope right now. Okay, so Carrie, I want to know about this 360-day lock. Thanks for sharing some of this info. Extended rate lock is about 1% of the loan. Money goes towards closing, capped at 4.75%. If it goes past 360 days, it's about $1,500 per month. Okay, so explain this part to me. It's about 1% of the loan. Are you talking cost? Are you saying with a $500,000 loan, you're paying 1%, 1 point? So it's $5,000 to lock in a 4.75? Is that it? And then every day after that, it's going to cost you about a third, or every month after that, it's going to cost you like a $1,500 a month extension. I'd be interested to see. There's a lot of people that are sitting in new construction deals right now where I think I can lock them for 6 months and pay something like half a point higher. Meaning if I could lock them at 399, I'd be locking them at 449 if I did it for 6 months. Let me price one real quick. See if I can figure it out. All right. We got YouTube example. I'm going to do a 500K purchase with 20% down. And primary 180-day lock. Yeah, see, the 180-day lock has a adjustment of 0.5%. So I'd have to get somebody, 4.5 or 4.6, just because there's that 0.5% adjustment. Yeah, like 4.5 instead of 399. I wonder. So what happens if they stay flat? I think that's the question I'd ask, right? So you're going to lock at 4.75. And what if there's better available when your house closes? What if rates go up and then they come back down? Not saying I think it's going to happen, but I would ask the question. Because then if the market rates 4.25, and you're locked at 475. Not so great. But the certainty of knowing what you're getting is certainly beneficial. And with the way housing is going, I think some people locking into a price of a home a year in advance, it could be beneficial, right? You could lock into this place, for 500 grand. By the time it's done, they could be selling the same model for 545. So you might be winning there where you're like, okay, I got a higher interest rate because I had to wait for the thing to be built before I could close it. But yeah. Okay, so you float back down to the market if rates are lower. So cool. I mean, I don't see much negative in that. I would I'd lock it up. Protect it against the downside for sure. All right, cool. Yeah, best of luck to you, Corey. All right, Joe. Thanks for joining. My 7-year window for foreclosure ended, but refinance people told me that I still have to wait another 2 months until April, since that's when the property sold. Is that normal? Yeah. So they're going to go off your discharge date. And so my guess is that your discharge date is April of 15, and it's a 7-year period from that. So I know it's frustrating for you, I'm sure. But in order for them to deliver it to Fannie and Freddie, conventional deal, they've got to have this new note rate on the new deal be 7 years from the discharge date of that foreclosure, which, if they've told you on paper April is the date where it officially sold and was foreclosed, then yeah, that's normal. Wish I had a better answer for you, but they're shooting straight with you. I'm in a new construction and my home isn't ready for 90 days. Sucks for me. Did lock in home price. Yeah, and I mean, it wouldn't hurt to look at what locking in the rate would look like. The Fed's meeting in March. They're going to tick up that Fed funds rate, which, like I've talked about in past videos, Fed funds rate and 30-year mortgage rate don't necessarily mean the same thing, but they're highly correlated, meaning that like the Fed's funds rate going from 0 to 0.5 to 0.75 to 1 to 1.25 to 1.5 over the next 3, 6, 12, 24 months is going to have an impact on 30-year mortgage rates. So we'll see 30-year mortgage rates continue to tick up, in my opinion. I would tell you to see what a 90-day lock looks like. The thing that I would make sure of is when any builder says you're going to be done in 90 days, this build will be done. It means it's going to be done in about 150, 120. So don't get yourself in a position where you're locked for 90. You got to extend another 30, extend another 30 after that. That can be really costly. And that's something that, is kind of like the crappy part about new construction is when there's delays. Sometimes not the builder's fault, right? They can't get appliances. They can't get the flooring they need. They can't get the wood for framing. Whatever the case may be, it might be out of their control, rolls down to you out of your control. And now, your lender out of their control as well, right? They can't grant you a free lock extension. The lender where they're delivering the loan has locked in that price, and it costs something to extend that lock. So that's my best advice there. Oh shit, supposed to be done this month. So yeah, kind of par for the course, right? That it's going to be 90 more days until it's done. God, that's kind of terrible. Are you working with the builder's lender or are you working with an outside lender? I'd be curious too if the builder has anything that they can do. Say, hey, if I lock my loan in for 90 days and you guys can't deliver me the product, can we get something in writing where you guys eat the lock extension fees? Or, if it's their lender, then maybe there's something that they can do. I don't know, but best of luck to you. Unfortunately, that's kind of how it works with new construction. Yeah, if they haven't even started the house, man, and they say 12 months, who knows? It might be 15 or 16. Okay, so you're using your realtor's lender, which they don't really have any pull with the builder or ability to like kind of hold the builder's feet to the fire. The builders, one, are generally behind schedule as it is. Two, in the current environment we're in, where things are delayed and it's hard to get supplies and whatnot. Like, yeah, it's tough. All right. Best of luck to you. Edwin Torres, New Jersey. Yes, sir. I'm going to connect with my buddy Sean Hammond, the best of the best. Just go to greatmortgagebroker.com. Say, this is me. I'm looking to purchase. I'm in New Jersey. Here's my timeline. Here's that. A few pieces of information. Bada bing, bada bang. My buddy Pete calls you. Hey, Pete. Thanks for reaching out. You're looking to do something in New Jersey? Let me connect you with Sean Hammond. And then you're connected with Sean. You're off and rolling. Best of luck to you. All right. Fire the questions fast and furious if you could. 1 hour. I'm going to try to keep these things. I want to continue to do this week in and week out. I think within an hour, we can answer lots of questions, helps a lot of folks out, and want to make these things efficient. So going to jump off here shortly. But if you have questions, put them in the comments now. If it comes down the road, a question of yours, feel free to ping me via YouTube. I might even create something where people can submit questions online. Then I can go through and answer those, find some way to bookmark them so that if you ever have a question where you're like, hey, this would be a great question for me to Google, but I don't want to find an answer from 2017 that might not be right anymore, ask it to me and I can answer it in quasi real time, right? If I get back to you within a week, that's a lot better answer than waiting to find a Google result that might land somewhere in the last year and that guideline might have changed or what. So I literally just thought of that idea right now. I'm going to create some. It's going to be awesome. All right. No more questions coming in. It was a pleasure, as always, answering your questions, getting your feedback. Maybe next week we'll talk about the real estate market, the future of the real estate market. I made a video that I thought, explain my thoughts on whether or not we're going to crash. That's live as of Saturday. I'll continue to follow up with some of the great conversations I had within the comments on YouTube there. All right, Pam, you're the last question. Great to see you here. I appreciate your support and looking forward to working with you. Did a cash out refi, sitting on the cash and waiting for a deal, and no deal. Recast the loan. So you're talking about, should you throw that cash back onto the loan and recast it? I personally would not. If you're comfortable with that new payment and it's not causing a burden paying that new mortgage payment, you're going to take that cash, throw it at your mortgage, recast it, and maybe it drops your payment by $300, right? I think that you go over the next 12 months, really hone in on your criteria, what you're looking for. And, looking back 10 years from now, I think if you had two different roads that you're faced with right now, continue to look for a deal, find a deal, something that matches with your goals, building wealth through real estate, whether that's, money in retirement, whatever that is, right? if that was the initial idea, I think you stay that course versus you take the money, you throw it back on the mortgage and recast it. You go down that path. And then looking back 10 years from now, you might look back and be like, oh, shit, what if I would have continued to look? What if I would have found something? What if I bought something that has since appreciated $250,000? I've paid down $90,000 of that debt, and in turn added $340,000 to my net worth. I saved $300 a month because I threw it back on the mortgage and recasted, but like that $3,000 a month saved me, whatever it saved me. I don't really feel that, right? Like that 3,600 a year times 10 is 36 grand. And maybe it went towards who knows what, right? A couple extra nights out to good dinners versus the 340,000 in net worth from finding something, getting in it, watching it appreciate, paying the debt down on it. That's my 2 cents. Hopefully that helps. Let me know if I can help. Thanks, Pam. Appreciate you. Have a good one. Thanks, guys.